Okay, everybody, it's me, Gregory Mannarino. It is Sunday, June 4th, 2023, and this is my newest segment of Markets A Look Ahead. Honestly, I'm a little bit off right now. I just found out that a good friend of mine, a member of my car club, passed away suddenly at the age of 45 years old. Still trying to discover what happened here. I'm not exactly totally with it this morning, but I wanted to get this video out. I think it's important because I do feel like I have an obligation to the thousands of you that do follow this blog. Okay, so with that, people, let's talk about something here. If you recall, roughly like 9 or 10 months ago, we outlined right here on this video blog how the banks were in trouble. All right. Obviously, this played out to be true. We have seen some pretty interesting activity with the regional banks, and I'm telling you right here and right now, I've said this before, these larger institutions, they're not immune. Remember what was going on here? What still is going on? No deposits, no loans, and no deals. As a matter of fact, last week we covered here in this video blog how the major banks have had the largest capital outflows that have ever been seen in more than 40 years. People are pulling their cash out of these institutions. Well, in my view, this is a good thing. There's no reason to keep your cash in one of these institutions when they're robbing you blind anyway. You have an interest earning account. Well, you're being robbed blind. What they're paying you with regard to interest isn't even keeping up with the rate of inflation they're telling you we have, and we know that it's much higher than that. No reason at all. Convert that cash that you don't even own. Again, what are all these things? Let's cover this again real quick here. Those bills that are in your bank account, that are in your wallet, okay, you don't own these things, okay? You work for the privilege to borrow these things from an issuing central bank. In this case, we're talking about the Federal Reserve. You work for the privilege to borrow that cash because it's not yours. You owe it back to the issuing central bank plus interest that they create magically out of thin air. What do I believe you should do with it? Sidestep it, okay? Convert this into hard assets. The most undervalued asset on this earth, in my opinion, what is it? What is it? You know what I'm going to say? Do it right now, okay? It's silver. Silver, why? Why does Greg Mannarino say that, people? You know this if you've been following my work. Just look at a couple of little things. Let your fingers do the walking here. Look at the Dow Jones Industrial Average gold ratio and then the gold silver ratio. It'll be as plain as day to you that we have a massive price suppression scheme going on here. If you look at gold and silver here for the last many months, they've been stuck in a very tight range. Now, despite the fact that we just heard, yet again, we have promised to vastly inflate the debt here, not just in the United States, but around the world. This is going on. You know how it works. Central banks, their power resides in one thing and one thing only, their ability to inflate. When you have, let's say, for example, here in the United States, we just raised the debt ceiling yet again. We are promising to borrow more from, in this case, the Federal Reserve. The debt must continually expand. It can never stop. You see, you're never going to hear a politician, a brain-dead president like Biden explain to you that the system demands, it absolutely demands that debt inflate. It gets larger and larger exponentially every minute of every day. The moment that that goes away, well, what would be the first institution to fall? Exactly. It would be central banks. You want to take away, you want to kill a central bank? You know how to do this if you follow this blog. You prevent them from issuing one single dollar of debt. Just one. That's it. And they fall. If we, for example, would have defaulted on our debt here in the United States, it wouldn't have taken long for the Federal Reserve to start to fail, which would have begun a domino effect, taking down central banks around the world. Why do you think we had Janet Yellen Stein, the U.S. Treasury Secretary, in a panic? Well, we had our current imbecile president in a panic. Politicians in a panic. We have to do this. We have to do this. We have to borrow more. Yes, of course, it would have created a great deal of economic pain had we defaulted on our debt, but we're going to get that anyway. You think we're out of the woods yet? Or have you seen the headlines since our brain dead president signed whatever legislation to allow them now to raise the debt ceiling? Now, oh, he saved the day. Our president, yes, he brought us back from the brink. Oh, and he's going to tout this during his re-election campaign. There's no doubt about it. Along with the fake data and everything else that's going on, you know that. So, with regard to what we're seeing here, I want you to pay attention to what I'm telling you. And I covered this recently, but I want to cover it again. The banks are in huge amounts of trouble, and the big banks are not immune. So massive capital outflows, more than we've ever seen in the last 40 years. And that's pretty incredible here. Now, the real issue, and I've been thinking about this a lot. Why is it, this is what I've been asking myself, why is it that the Federal Reserve, the corporate agenda here, is so hell-bent on keeping the stock market propped up? And then it hit me. Right here. Right here. These mega banks are so exposed to derivatives that it is frankly beyond belief. Now, I want to read a couple of things to you here. So, again, here in the United States, we are $32 trillion in debt. Now, the top three banks with regard to derivative exposure have over $150 trillion worth of derivative exposure. Goldman Sachs alone has over $53 trillion worth of derivative exposures. The next one in line would be JP Morgan Chase. This is over 50 trillion, yeah, you're hearing that number right, in derivative exposure. Citibank, over $47 trillion. Now, this list goes on and on and on and on. I just printed out a little bit here. Now, if you want a copy of this entire list just to see if your institution is here, I'm going to place a link in the description of this video so you can see how unbelievably monstrous this is. So this is the real reason here. This is it, in my view. I'm thinking to myself, what's really going on here? Other than the fact that they are trying to get as many people in this market as they can for when they pull the plug and everyone gets slaughtered. That's eventually going to happen. But again, you know as well as I do that the big implosion is eventually going to begin and end in the debt market. Now, what's going on here in the debt market? The debt market is being pumped and pumped and pumped even more. We've watched some pretty incredible action here. The entire yield curve in the United States, which remains the most inverted that we have ever seen in history, which is a clear sign. I mean, look back on history. An inverted yield curve invariably shows us that we're marching into a severe economic decline. And we already know we're in a recession, moving into the greatest depression of all time. That's clear. That is happening here. The economy is in free fall. Why has the Fed, tell Greg Mannarino again, just real quick, what's really behind the Federal Reserve raising rates? Is it really to stop inflation? Is it really to slow down inflation? Because all we've seen is inflation continue to rise, and all we've heard from the Federal Reserve and other central banks is, it's sticky. It's a lot worse than we thought. No one saw this one coming except you and I. We knew this was coming from a long time ago. But the real reason here why they're raising rates is to, again, cut off the availability of credit to especially U.S. small businesses, here referring to the Federal Reserve. They want to eliminate small businesses so the large corporate agenda can be fulfilled. No competition. They are pressuring the consumer. Food inflation rising at its fastest pace ever in history. Okay, that's not going to stop either. You can expect that. But going back to this is the key. This is the key as to why these institutions, the major banks, are in a lot of trouble, and as to why they are so desperate to keep propping this up. I mean, just think about it. What do you think about this, honestly? The top three banks alone, Goldman Sachs, JP Morgan, and Citibank, between these three institutions, over 150 trillion with a T, okay, derivative exposure. And this goes on and on and on and on and on. This is pretty incredible, and I think it's really the backbone of what's going on here. Because you have to understand, once this starts, and it's going to, I mean, what are derivatives anyway? Let's clarify this for those of you that don't know. A derivative is nothing but a side bet. You can have a derivative of anything. In this case, these can be exposure, like no one can actually figure out what this is here, okay? This is kind of stuff that you can't quantify, all right? And not only, the issue with derivatives is, again, there's layers of them on both sides, on the positive side and on the negative side. So there are bets to the upside and downside on these derivatives, okay? And like I said here, all a derivative is a side bet. Let's say, for example, Apple stock is trading at XYZ. You can take a side bet, which would be a derivative, okay? That Apple stock is going to do this, that, or the other thing in the future. And then you can have a side bet on a side bet, and a side bet on a side bet, and a side bet on a side bet, and a side bet on a side bet. It goes on and on and on and on and on. It's incredibly toxic, and it's in the multiple quadrillions. I mean, this is just the surface of it here. We're just scratching it here. But again, I want you to have a copy of this, and I'm going to put a link in the description of this video so you can look at this for yourself and see if your own institution is there. So anyway, with regard to this market here, we watched some pretty incredible action here as of late, but no surprise, I don't think. We have covered here in this blog repeatedly, if they can manage to keep rates suppressed and not hit that 250 on the MMRI, Mannarino Market Risk Indicator, link in the description of this video, the market would mostly go higher. They're pumping it. By keeping rates suppressed, what does it do? You know what it does if you follow this blog. It opens up a doorway for cash to make its way into risk assets. Risk assets being stocks. It inflates a stock market hyper bubble. That's what we have now. A real estate hyper bubble. Malinvestment, meaning cash coming out of things that it should be going into, gold and silver, for example, and it creates distortions across the spectrum of asset classes. You understand? And there's going to be a terrible price to pay. But then again, that's the backbone of it all. Derivatives. Derivative exposure is the key. And we're going to keep a closer eye on this moving forward here, people. Anyway, look, I want all of you to ponder the things I have spoken about. Look at energy lately. The run-up it's had off of its recent low. We knew that was coming. We covered that. Energy, commodity prices, people, you haven't seen anything, nothing yet as to how this is going to play out. Again, how is it going to play out? Let's talk about that real quick. You know already, implosion in the debt market, rates spiking eventually in an uncontrolled fashion will crush global stock markets. Cash will move. It'll just move from one reality into another. It doesn't grow money wings and fly away. It's going to move into commodities and, in my view, also into cryptocurrencies as well to a large degree. Anyway, that's how I see it. I want to hear from you on all of the stuff we covered here. People look, with regard to like losing someone that's close to you, like I just lost my friend here, Josh. 45 years old, sudden death. You know, you just never know when things are going to happen. You know, most of us probably don't tell those that we're close to enough that we love them. I should have told Josh that. I never got that chance. I wish I did. If you can hear me out there, Josh, I love you, bro. I miss you. Anyway, go tell someone today that you love them. It's just so important because you just never know what's going to happen. I'll see you tomorrow morning for my, excuse me, for my morning report, okay? I got to get myself together here. Sorry. Love you all. I really do. I mean that from the heart. I love all of you. I love every freaking single one of you. That's the truth, all right? I'll see you in the morning.